November 8th, 2024. Today was a today was a bull channel day. What I meant to say is what today was a bull channel day. We basically had a spike in channel over the past couple days though. Past 2 or 3 days have been bull channel days, and in general, when you get a gap up, so a spike in channel, the channel will usually last about 200 bars or 2 to 3 days. This was a little bit protracted, so it's a little bit longer than most channels last. But you can see we had the large spike, and then from where the bull channel started, we ended up getting a second leg up into, oops, that was the wrong measure move. Hold on. I did it 2 minutes ago. I meant to go from the 77 or the 76 low here because this is the start of the bull move, and then we get a big spike. So you get up here, and then the second leg, and that's around where that is. It's possible we just got a measured move up of the spike as well, because when you get surprise bars, okay, we haven't quite reached that measured move yet. But the one that I saw that was obvious to me or made sense to me was the spike and the gap up, and then the pullback, and then bull channel higher. Today, it's okay to not trade for a long time on these days. It's really eager. It's very natural for traders to think that they have to take trades, but it's pretty okay to not trade through this because the reality is it's difficult. If you're going to trade in here, it's better to be trading on limit orders, and most traders should not be trading limit orders. They should be trading stop orders. And so in this general area, it's probably better just to be flat and not take any trades. Some traders, like I said, will trade on limit orders, but for the most part, if you're not profitable yet, you shouldn't be trading on limit orders. The reality is, whether you accept it now or accept it in 5 years, the way you become profitable is you swing trade always in. There are zero people who are going to become profitable traders by starting out trying to take limit order trades. If you spend your time learning swing trading and always in, you will eventually get to a place where you start to learn limit order scalping just naturally as it progresses. But you are not going to start off your career as a limit order scalper. It's not going to end up working. You might think it's working, and it might work for a day, a week, maybe even a month. But the reality is what's going to end up happening inevitably is you're going to have a massive loss or two, and that's going to erase all your winners. The problem with limit order trading is you're going to win just enough times to make you think you know what you're doing, but inevitably you're going to lose. So the trade that I like to take is just leg ones for a second leg. And I made a video on it the other day, and I took one trade today. And if you watched my video the other day, pause the video now and take a guess as to what the trade that I took today was. If you thought that about the close of 50, you were right. All I did, buy the close of 50, went for the measured move, and I put a stop below 48 and just got out up here. Some traders, they prefer to use 51 since they want one more follow through bar. That's fine too. You buy, you go for a measured move up, it hits your target. It doesn't quite fill you, so you could exit, at the market, or you could exit below here, maybe a measured move down of 63, something like that. But what's really important to do, is stop trying to catch the spike. So stop trying to anticipate the spikes or scalp on limit orders, and rather just let the spikes happen and get in on the bull channels. You'll find that bull channels are much easier to trade if you learn to sit through small pullbacks like this, 1 or 2 bar pullbacks, rather than, occasionally 3 bar pullbacks, depending on the context. But in general, if you let a bull spike happen and then buy a bull close and allow for 1 or 2 bar pullbacks and let the market go, with you and with trend, you're probably going to be surprised at how quickly you're going to start making money. Bar 1, a bull bar, but a large tail on the top. So the open of bar 1 is the low of the day. And usually, the market will trade at least 1 tick below. This only happens about once a year. However, it did happen, I believe it was last Friday as well. Yeah, it happened here as well. Last Thursday, the open was the high. That's really, really unusual to see twice in a couple of weeks, since that pattern usually only happens about once a year. So pretty cool to see the open of the day be the low of the day as well today on bar 1. Bar 2, an inside bar, a possible low 1 short for the bears, but there's probably buyers below. Some traders would argue it's a parabolic wedge. 1, pullback, 2, pullback, 3, but it's really not worth selling below 2 since it's a bull bar. Bar 3, a bear bar, obviously buyers below 2, scaling in lower. Bad sell. 4, a bull surprise. Good for the bulls. We're probably going at least a little bit higher. The reality is over the past couple of days, we are a little bit oversold. So it's really not as perfect as it could be for the bulls, and we don't close above the high of yesterday, and there is a tail on the top. So still good for the bulls. We're probably going higher, but again, not as great as it could be. 5, a bull bar, but tail on the top and tail on the bottom. It's more of a doji bar. So we have a doji bar on 2 and doji bar on 5 as well. 6, another bull bar. So 3 straight bull bars, 4, 5, 6. It's a big, small, big pattern. So big bar on 4, small bar, essentially a doji bar on 5, and then a bull bar on 6. What this really means is that there's an increased chance that we're going to pull back and go a little bit more sideways before we go higher. So while 4, 5, and 6 are strong and we're going to get a second leg up, the big, small, big pattern should make you think, okay, we might have to pull back before we do end up getting that second leg. 7, a big outside down bar, a bit of a surprise bar, should get at least a small second leg sideways to down. Do you sell below 7? I mean, you probably can, but it's a swing trade, right? And your risk is relatively large. You're risking about 8 points, and you're trying to make 30, 40, 50 points, taking a chance that this is a bear trend day if you're selling below 7. So it's not illogical, I don't think, to sell below 7 and take a chance it's the high of the day. But we have a pretty tight channel up from bar 78 to bar 7. So odds are 7 probably is not going to work. Maybe a 30% chance that bar 7 is the high of the day. So the question you have to ask yourself is, are you willing to sell below bar 7 and feel okay with losing that 7 times out of 10? 8, follow through for the bears, a doji bar. So not perfect follow through. I think if you're a bear, you wanted to see a big follow through bar. And instead, you get a more side, a little bit of a more sideways bar on bar 8. 9, another bear bar. So 3 straight bear bars, 7, 8, 9. But basically doji 8, doji 9, large tails on both sides. So really not as good as it could be. Again, the bears who are short are betting on a parabolic wedge and a failure above yesterday's high. I believe that is yesterday's high. Yeah, above yesterday's high. 10, a bull surprise. Good for the bulls. We're probably going at least a little bit higher, and you have to expect some sort of follow through here. You know that 10 is strong enough for its own second leg. So even if we do pull back, we're probably not going to pull back all that far. And you know that there's probably buyers at the bar 8 high and the bar 9 high, which is a gap that we kept open, right? The 8 high and the 9 high. But there were 2 more important gaps. And I'll again, you should pause the video, take a minute, but there were 2 more important gaps, let's say in the opening 15 bars. There were 2 open gaps that were extremely important and gave a hint that this could be a bull trend day. So take a second, look through the chart, see if you can find the 2 open gaps. A hint would be to use a line chart because line charts show body gaps, and they were body gaps. So the bar 3 open and the bar 9 close is one body gap, and the second body gap is the bar 6 close and the bar 11 close. You can see they didn't quite overlap, but they closed on it, but it did not overlap it. So technically, it was still an open gap. If we look at like a line chart, it would touch it, but it does not go over and through that area. So we have a little open gap here and an open gap here as well. So 2 open gaps early on for the bulls. In general, with open gaps, you want one of them to be a body gap and one of them, or at least one of them to be, a gap, an actual gap, and not necessarily just a body gap. But when you don't get that, it sometimes ends up being more of a bull channel day, like today, rather than a really, really strong bull trend day. 11, a doji bar for the bears. Bears are hoping double top 7, 11, and a swing down, maybe below the bar 9 low, but not really all that likely. Probably buyers below, scaling and lower. 12, sellers above 7, scaling and higher. Good for the bulls. We're probably going at least a little bit higher. 13, a bull bar closing near its high. Again, good for the bulls. Some bears would argue 10, first leg up, pullback 11, 12, 13, second leg up. But I'm not really sure how much higher we're going. We're probably going to find sellers at some point up here. 14, buyers below 13. So expecting buyers below, scaling in lower. We should get back up to around the 13 close. And again, on bull channels, a lot of times it's much easier for traders to buy below bars. Look to buy below 13, look to buy below 6 rather than these closes. So that's good for the bulls. As I mentioned, buyers below on 14. 15, a bull bar. Decent close, but again, it's closing up near the 11 or the 13 close. And bulls not necessarily eager to buy the 13 close. They're more interested in buying lower and then scaling in and scalping out. 15, a high one for the bulls. Probably, again, like I'm going to say a lot today, probably going at least a little bit higher. 16, more follow through for the bulls, a bull bar, but again, a tail. So what you notice about this is the shape is a tight channel, right? We're in a reasonably tight bull channel. It's clearly not, necessarily a trading range, but it'll probably evolve into a trading range at some point. But when you're in a tight bull channel, you simply have to expect the market to continue to go higher, regardless of the fact that the closes aren't really all that ideal. 17, three straight bull bars, 15, 16, 17, tails on 15, tails on 16, tails on 17, 18, an inside bar, a possible low one sell. Or you could argue it's a low three sell, but nobody's selling that. Buyers below 18, buy the low, scale in lower. 19, you can see there were buyers below 18, ready to scale in lower, probably going back to a new high. 20, a big bull bar, back to around the 19 close. 21, consecutive bull bars, 20, 21, up to a new high. Probably sellers above scaling in higher. The bears who have sold to the high, willing to scale in and try to make a couple points, have consistently been able to do so. But again, not really a very profitable thing to do, mildly profitable at best. 23, another bull bar, but not really that great. We have 21 and 22 doji bars, and then 23 a bull bar, yeah, but with 21 and 22 being doji bars, and where's your stop, right? So if you're buying the close of 23, stop below 19, really not as great as it could be. We might have to test back down to the 19 low. Keep in mind, higher lows in trends are support. So the 19 low is support, the 15 low is support, the 11 low is support, the 9, 10 low is support, the 1 low, the 3 low, these are all support areas. 1 second. All right. 24, a bull or a doji bar. So, small pullback, but still a small pullback bull trend. Remember, the definition of a small pullback bull trend is pullbacks between 1 and 3 bear bars. So 3, 1, 1. Generally, you want it to be 1 or 2. You don't want consistent 3-bar pullbacks. That's not great. We have an attempt to convert into a trading range, but then a bull surprise 37, which puts the small pullback bull trend back into effect. 2-bar pullback, 1, 1, 2, 1, 1, 2, 1. And then 3, bulls can exit. Or, as you get better, you can learn to exit higher. But still, if you just held on the premise, if you bought the close of 37, held on the premise of small pullback bull trend and exited after you got 3 straight bear bars below 66, I still think you did a good job. 25, another doji bar. So lack of momentum, 24, 25, right? 26, another doji bar. So really not all that great. And you can see, what do you notice? What is the difference between what we're doing over here and what we're doing in here? Look at all these doji bars, 18, 21, 22. It's not really a doji bar, but it's small. 24, 25, 26, all dojis. So 21 through 26, you could argue are all dojis, or at least 5 of them are dojis. So really not as ideal for the bulls as it could be. We're probably going to pull back soon. However, we haven't gone below the moving average in 27 bars. So the moment we get to the moving average, you're expecting buyers. 27, a bear bar, but more of a buy the close bar than a sell the close bar. And then a bull bar closing near high 28. If you buy above 28, you have to kind of understand the concept of what you're doing. So people, I think one of the problems with traders is not understanding stop placement, which is why a simple system makes sense. But if you're buying above 28, you can't put a stop below 28. It just doesn't make any sense. There's going to be more buyers below 28 than sellers. So if anything, if you're buying, you want a wider stop down here, down here, down here, and you want to be scaling in, buying more below 27 instead of selling out of your longs below 27 or 28. 29 consecutive bull bars, 28, 29. But again, not great follow through, right? So the bulls who bought, this isn't as ideal follow through as they want, and some of them scalp out at the high. 30 a bear bar closing near its low. We might go to the moving average. This was the best looking test of it so far on 27. And with all these dojis, we're in a tight trading range, so we might test it. 31, another bear bar, but a tail on the bottom. We do touch the moving average for the first time today, probably buyers below. 32, another bear bar. Sellers above, but still always in long, so it's really not great to be selling. If you're going to be trading limit orders, you want to trade with the always in direction. So you probably want to be buying below bars more so than selling above anything on this day. 33, an outside bar. It's the second leg down. Good for the bulls, or good for the bears. Leg 1, pullback leg 2, but probably buyers in this area, scaling lower. 34, a bull bar closing near its high, or sorry, not quite near its high. It's a high 2 for the bulls, but again, a tail on the top. So this is probably converting more into a trading range at this point. 35, a doji bar, disappointing for both sides, but buyers below. 36, and then 37 is what changes it when you get a giant bull bar closing near its high like that. This was starting to convert into a trading range, and then you get another bull surprise on 37. 38, disappointment, right? If the bull bought closed 37, you're disappointed with 38. 38 is a higher high major trend reversal, but only about a 40% chance of it actually converting into a major trend reversal. So really not that ideal. When you get disappointing follow through on 39, what happens? Well, a lot of the bears who sold, they don't like a doji bar on 39, so they bail out of the trade, and that causes 40, a bull bar. Other bears who stayed in the trade, they'll scale in on 40 and 41 and use 42, 43 to buy back their shorts around the bar 38 low. So bounce 40, 41, probably buyers below scaling in lower. 42, a bear bar closing near its reasonably near its low, and buyers below 43, 44, a doji, and we're just basically in a tight trading range here. So what should your brain go to, right? When you start getting a tight trading range deep in a bull trend, your brain should start to think final flag. And you could argue it was a final flag because while we did break out above it, we obviously ended up coming back into that area. So 48, bull bar, but again, tight trading range, and then the large breakout 49, 50, bull bars expanding, getting larger. So definitely a bit climactic, and the breakout itself is pretty climactic, but we're still going higher. 51, a bull bar, but a doji, so really not that great. Disappointment, 52, but still a bull bar, but still not a bear bar. So buyers below, scaling in lower. 53, a bear bar, closing near its low, but it's really just at the 49 high. So if you're, a bull, there's a small open gap here. Bulls are going to be ready to buy the bar 49 high. When gaps fill, generally any trader who sold above 49, pretty disappointed with how 50 and 51 looks. So they're going to use this to buy back shorts. And because of that, bulls are going to wait, trying to buy the breakout point of any bull bars. So more of a buy below 53. If anything, I would not exit longs below 53. What you really need to do is wait to see if 54 is also a bear bar that looks like 53. What you'll find is that if you're exiting trades early a lot, I would challenge you to think about it a little bit differently in the way that you're probably exiting. So if you're exiting below 53, why are you exiting? You're exiting because you're scared that 54 is going to be another bear bar. If you're scared that 54 is going to be another bear bar and you're going to take a massive loss on the trade, you're probably trading too large. If you're just generally scared that 54 is going to be another bear bar and you don't want to lose money, what you should do just this upcoming week, or not even necessarily the upcoming week, the upcoming month, I would say even, is make the bears force you out, right? So don't exit below 53. Say to yourself, why do I want to exit below 53? What am I scared of? And you'll start to come up with conclusions in your mind as to what's actually going on behind the scenes. You'll think to yourself, okay, I'm actually scared of 53 because I'm scared that 54 is going to look like 53. So then say to yourself, okay, if 54 looks like 53, then I will exit, right? So if we get another bear bar on 54 that looks exactly like 53, then I will exit. And what you can do, if it helps, is just close your eyes for 5 minutes or turn around for 5 minutes or something, and then turn back. And if 54 is another bear bar, which sometimes it will be, right? Sometimes the bears will get that bar and you just have to get out and you lose a little bit more money. That's fine. But the reality is the vast majority of the time, it's not going to happen. And then you're going to get another bull bar and you'll be glad you didn't get out. So instead of, traders are so focused on trying to get out of trades quickly to not give back any money. And that's the actual opposite mindset that you want to have. You want to be the last trader getting out of the trade. You want to be trading always in when you're starting. So everything, if you're a beginner and you just want to do limit orders, you're thinking the opposite way. And that's okay because you're supposed to think the opposite way at first. But the fastest way to become profitable, if that's what interests you, is to trade always in and make the bears force you out. So in this scenario, if you had bought for any reason in here, let's say you just bought above the bull bar closing your tie, you bought above 37. Good trade. You waited, you said, well, the bears need one more bar to force me out. Everything in here is minor. It's probably, what are the odds any of this is going to get followed through? Really not very good. You could have held and made a pretty good profit. Obviously, there comes a time where you have to take profits, and that'll be a difficult thing to learn. But again, it's the easiest, fastest way. 54, a big outside up bull bar, a large tail on the top. 55, an inside bar, a high one buy for the bulls, probably sellers above, scaling it higher. 56, another bull bar. Again, we're channeling higher here. An inside bar, 57, sellers above during 58. An inside bar, 59, another eye, so just high ones, probably going a little bit higher, but I'm not sure how much higher. The obvious target is the measured move. When you get a spike like this, you're probably going to get a measured move up. And the measured move, what do you know, is the exact high of the day. Not really that surprising. 62, a breakout above the bull channel. But the thing is, this whole thing, we have a multiple day bull channel. And the whole rally up here is basically a breakout attempt above the bull channel. So it's kind of difficult to think that we're going to go that much higher, 62. Any bull who does buy the close of 62 is betting that 63 is going to look like 37. That's another thing. If you're taking lower probability trades, you buy the close of 62, you want 63 to be a huge bull bar. You want to get swept into a massive bull trend if you're buying up here. And if you don't, you want to immediately get out like traders do on 63. Or after seeing 63, you can see 64 went one tick above the 62 high because the bulls who bought the close disappointed. They ended up selling out of their longs, and that causes 64. Bulls can exit below 64, should exit below 64, or can wait for one or two more bear bars, 65, 66. You have to get out below 66 after 3 straight bear bars. closed below the moving average, but not really that great. And then 67, sort of just the bulls exiting, right? That's why you get a bit of a climactic bar on 67, an inside bar 68, and you can see we get a second leg down. You could argue, you can make an argument, with my leg one system that 67 was the sell the close bar, but I'm not selling against a bull trend. You did get the measured move if you took it, but I'm not really going to sell against the bull trend in this context, especially when 67 had a huge tail on the bottom. So really not as great as it could be. So I probably would not. As far as trades on the day, so possible buy the close, sell the close. You could have bought above 6. In theory, you could sell below 7, but I don't know. It's probably just a lot better to just wait, honestly. It's very low probability. You could probably buy above 10. Nothing's really great. 37. And then buy the close 50, 51. Exit below 60, 64. So nothing was all that ideal on this day. If anything, if you were a limit order trader, just buying below bull bars makes sense. But again, I would not encourage limit order traders if you haven't been trading for a long time. The daily chart, we're obviously getting a climactic breakout to a new all-time high, and we are in a bull channel. So it looks like we're, if you turn on Globex, it's more obvious. Look at this, right? This is our huge, basically a huge bull breakout. And the bulls are hoping that we get a large breakout above, this bull channel and a big measured move up, whatever, 6,400, 6,500. It's probably not going to happen. These magnets, 6,000, 5,000 are too important. So I don't really think it's all that likely. The weekly chart, obviously a really large bar, but what do you think when you see that? Do you think that that is the start of a new bull trend and that we're going to break out above this steep channel and go way higher? It's probably a pretty climactic bar. So we might have to pull back to at least the breakout point, 59.21. I think the big target for the bears, for the bulls, was 6,000. And now that we've reached it, we might start to go a little more sideways. If you can see, the bulls, really strong month so far, obviously. And this never triggered. So the bears who were trying to sell below the October low and the bulls who were willing to exit below the October low, in case we had a sell off towards the moving average, basically end up exiting their longs. You can see we haven't been, or never end up exiting their longs because we never go below there. You can see we haven't been below the moving average in quite some time. So what do you expect the first time we go below the moving average? First time we go below the moving average, we're probably going to find buyers. So if we get a deep pullback, and I know it's really easy to look at this and think, look at a daily chart, right? And think, oh yeah, look how far away 5,000 is. We're never going there. But if you look at a monthly chart, and I said, look at it from this perspective, and this is what I'd have to pull back to go to 5,000. And if you give it 2 or 3 years, is it reasonable to think we're going to get here? Yeah. So if we get a deep pullback, what 20-ish% would not surprise me. All right, that is going to be it for this video.